Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. My name is Berliel Vidamayanti, a tax diploma student from STAN Polytechnic of State Finance. So because of coronavirus, I'm going to online class today, so I can't go to my campus. I really miss my campus. The last time I went to campus was in February 2020. Okay, so on this occasion, I will discuss about chapter 3 in Advanced Accounting. It was about an introduction to consolidated financial statement. It was a fun lesson, so let's get started. Okay, so the important point that I would like to discuss is about first, benefit and limitation, second, subsidiaries, and third, consolidated balance sheet at date of acquisition. Well, we will discuss the first point, which is about the benefit and limitation. First thing first, we have to know about business acquisition. An acquisition is when one company purchases most or all of another company's shares to gain control of that company. Business combination through stock acquisition acquire controlling interest in voting stock, more than 50%, and may have control through indirect ownership. Business combination occurs once. Acquisition of additional subsidiary stock is simply additional investment. Next, we'll talk about consolidated statement. Consolidated statement is financial statement of a group in which the assets, liability, equity, income, expenses, or cash flow of the parent company and its subsidiaries are presented as those of a single economic entity. The consolidated financial statement primarily benefit the owners and creditor of the parent company, not primarily intended for the non-controlling owners nor the subsidiary creditor. Subsidiaries issue separate statement for the benefit of their owner and creditor. Okay, now we'll talk about subsidiaries. A subsidiary company or a daughter company, yes, it's a daughter company, not a son company, is a company that's owned or controlled by another company, which is called the parent company or holding company. The subsidiary can be a company, corporation, or limited liability company. In some cases, it is a government or state-owned enterprise. Subsidiaries are a common feature of business life, and most multinational corporations organize their operation in this way. Examples include holding companies such as Berkshire Hathaway, Jefferies Financial Group, Walt Disney, Warner Media, IBM, and Xerox. These and others organize their businesses into national and functional subsidiaries, often with multiple levels of subsidiaries. So subsidiaries is when a corporation whose outstanding voting stock is over 50% owned by another corporation is a subsidiary of that corporation. So subsidiaries are consolidated. The parent company and its subsidiaries exist as separate legal entity and maintain their separate accounting record. However, each reporting period, their separate accounting records are combined into one set of consolidated financial statement for reporting the financial position and results of operation of a consolidated reporting entity. But there are some cases where a subsidiary may be excluded from consolidation. 1. Control doesn't rest with majority owner. 2. Joint venture. 3. Acquisition of group of assets that don't constitute a business. 4. Combination between entities under common control. 5. Combination of not-for-profit entities or acquisition of a for-profit company by a not-for-profit entity. Okay, now we will talk about consolidated statement. The purpose of consolidated financial statement is to present it fairly, primarily for the benefit of the owner and creditor of the parent company. The result of operation and the financial position of a parent and all of its subsidiaries as if the consolidated group were a single economic entity. The consolidated financial statement is prepared by a parent company. The parent company discloses consolidation policy and any exception to consolidation. The fiscal year end for consolidated entity is used parent fiscal year end but may include subsidiary statement with fiscal year end within 3 months of parent's fiscal year end. Okay, the last topic for today is we will talk about consolidated balance sheet at date of acquisition. Okay, now the example here is about Pop and Sons balance sheet. So it is acquisition cost equals fair value equals book value. So Pop acquires 100% of Sun for $80, which equal the book value and fair value of the net assets acquired. So the math is cost acquisition $80 less book value $80. So there is no excess of cost over book value. To consolidate, we have to eliminate Pop's investment account and Son's capital stock and retained earnings. You can see the Son's balance sheet here. Okay, so this is the consolidated balance sheet of Pop and Son. As you can see here, we have to eliminate the account investment in Sun and capital stock and retained earning in Sun account. So the total asset should be equal with total equity and liability. Well guys, that's all for myself. I hope this video can help you understand more about advanced accounting, and I'm sorry if this video have many noises. It's beyond my control, so I'm sorry. Goodbye.